Let's talk about something that 99% of people who hold Iraqi Dinar or Vietnamese Dong have completely backwards. The entire conversation around these currencies is fixated on one event, on one magical future moment, the revaluation. But in obsessing over a hypothetical tomorrow, everyone is missing the critical, active, and very real marketplace that exists for them today. I'm not talking about the black market. I'm not talking about shady exchanges. I'm talking about the legitimate, institutional, multi-billion-dollar trading floors where the value of the dinar and dong is being negotiated, hedged, and set right now. This isn't speculation. This is the factual core of the global foreign exchange system. If you don't understand where and how these currencies actually trade with volume and legitimacy, you are basing your entire strategy on a fundamental misunderstanding of how money works. Today, I'm going to pull back the curtain on the real FX world for the IQD and VND. We will walk through the three specific trading venues from the most accessible to the most influential, explain who the real players are, what moves the price in these markets, and crucially, why this knowledge is the single most important tool you can have as a holder. This changes everything. First, we must establish a foundational truth that shatters the common narrative. The Iraqi Dinar and Vietnamese Dong are already actively traded on the global foreign exchange market. They are not untraded or locked currencies waiting for a switch to be flipped. They have ISO currency codes IQD and VND, and these codes are live on trading platforms. However, and this is the crucial distinction, they are traded in what is known as exotic or frontier currency pairs ***. This is the first layer of the market most people miss entirely. In the world of Forex, currencies are categorized by liquidity and accessibility. You have the majors like Euro, USD. You have the minors or crosses like GBP, AUD. And then you have the exotics, which are currencies from developing economies, often with capital controls or less liquid markets. The IQD and VND sit squarely in this exotic category. They are not for the average retail day trader on platforms like eToro or Forex.com. Because the spreads, the difference between the buy and sell price, are often prohibitively high for small-scale speculation. A retail platform might show you a quote, but if the spread is to 100 pips, you're instantly down a significant percentage the moment you trade. This high-cost barrier effectively prices out the casual speculator and creates the illusion that nobody is trading it. But move up the chain, and the picture changes dramatically. The primary, legitimate trading of IQD and VND for non-residents occurs in the ***, counter OTC and non-deliverable forward and DF markets ***. This is the second and most important layer that almost all retail holders are unaware of. Let's break down what this means. An OTC trade is not conducted on a centralized exchange like the New York Stock Exchange. It's a direct agreement between two parties, usually large institutions. An NDF is a specific type of OTC derivative contract. Here's how it works for a currency like the VND, which has strict capital controls. To major banks, say HSBC in London and Standard Chartered in Singapore, agree with contract. They agree on a specific exchange rate for the VND USD pair for a future date, say 6 months from now. When that date arrives, they do not physically exchange Vietnamese Dong. Instead, they settle the contract in a fully convertible currency, like US dollars, based on the difference between the contracted rate and the official spot rate set by the State Bank of Vietnam. They are betting on, or hedging against, the future movement of the dong's value. The volume in these NDF markets is enormous, involving billions of dollars. This is where multinational corporations operating in Vietnam hedge their exposure. This is where global investment funds take positions on Vietnam's economic growth. The trading desks making these decisions are in global financial hubs: London, Singapore, Hong Kong, and New York. The prices established in this NDF market are a direct reflection of institutional sentiment on the currency's future trajectory. It is a pure price discovery mechanism. If you want to know what the smart money thinks the dong is worth in the future, you don't look at a tourist exchange booth in Hanoi, you look at the 12-month VND and DF rate. This market is real, it's active, and it's where the future value of the currency is being priced every single business day. Now, for the Iraqi dinar, the landscape is similar, but with a key difference tied to its unique situation. Iraq has been working to dismantle its complex web of currency restrictions and unify its exchange rates, a key requirement of its International Monetary Fund program. This process has opened up more direct trading avenues. The IQD is also traded OTC, but with a growing emphasis on deliverable trades for approved purposes. Major international banks with corresponding relationships in Iraq can and do facilitate IQD transactions where their institutional clients engage in legitimate trade. With Iraq think oil service companies, construction firms, and agricultural importers. These are multi-million-dollar transactions to pay for goods, services, and salaries within Iraq. The rate used is the official Central Bank of Iraq CBI rate, which itself is now more aligned with a market-reflective rate due to the new dollar auction rules. Furthermore, there is a developing secondary market for Iraqi government dollar-denominated bonds ***. The yield demanded by investors on these bonds is intrinsically linked to perceptions of Iraqi sovereign risk and, by extension, the stability of its currency. If bond yields spike, it reflects fear about Iraq's ability to manage its finances, which pressures the dinar. This bond market is another sophisticated venue where the IQD's perceived value is indirectly traded and assessed 24/5. So, who are the real players in these markets? They are not retail holders with a few $1,000s in notes. The players are ***1. International commercial and investment banks ***Citi, JPMO, RGAN, HSBC, etc., running their exotic currency desks ***2. Hedge funds and asset managers running dedicated emerging or frontier market funds ***3. Multinational corporations with operational exposure to Iraq or Vietnam ***4. Sovereign wealth funds and pension funds allocating a small portion to alternative assets. These entities trade based on cold, hard data, IMF report cards, quarterly GDP growth figures from the General Statistics Office of Vietnam, monthly oil production data from the Iraqi Ministry of Oil, changes in U.S. Federal Reserve policy that affect dollar liquidity, and political stability assessments. They are not trading on rumor forums. They are trading on macroeconomic fundamentals and regulatory progress. When they buy a VND and DF contract, they are expressing a belief that Vietnam's export-driven economy will continue to strengthen and that the state bank will allow a gradual, controlled appreciation. When they facilitate an IQD payment for a client, they are betting that Iraq's financial reforms will hold and that the currency corridor will remain stable. This brings us to the critical implication for holders of physical currency, the concept of liquidity. In the world we just described, liquidity for the IQD and VND exists at the institutional, OTC level. A hedge fund can exit the $10 million VND and DF position with a phone call to its prime broker. However, this liquidity does automatically translate to the retail level for physical note holders. These are two separate, parallel universes. The bridge between them, the process of converting your physical, non-deliverable notes into the digitally traded currency of the institutional world is the single greatest point of friction and the core of what a future revaluation event would actually need to solve. It's not about changing a number on a screen. It's about creating a secure, compliant, and scalable mechanism to bring a massive overhang of physical cash into the regulated digital financial system. The trading venues we discussed are where the destination value is set. Your challenge is getting your asset from its current form into that system. Therefore, the most important action you can take is to align your strategy with the reality of these markets. First, stop evaluating your position based on retail-centric hype. The price signals that matter come from the NDF markets, the CBI's official bulletins, and sovereign bond yields, not from YouTube videos predicting specific dates. Second, understand that any future process will be governed by the compliance standard of the very banks that run these exotic currency desks. They operate under draconian anti-money laundering and know-your-customer rules. Your proof of legitimate acquisition for your physical notes is paramount. Third, recognize that regulatory milestones are more important than speculative dates. For the Dong, watch for any further loosening of capital controls by the State Bank of Vietnam. For the Dinar, watch for the full and sustained unification of the exchange rate and the successful implementation of the central bank's digital currency platform. These are the tangible events that the institutional traders are monitoring, and they are the prerequisites for any meaningful change in accessibility for retail holders. In conclusion, the Iraqi Dinar and Vietnamese Dong have a vibrant, active life in the global financial system that most holders are completely disconnected from. They trade in the rarefied air of institutional finance, where billions move based on fundamentals and policy. Your path forward is not to wait for that world to notice you, but to understand its rules and prepare to meet its standards. The where they trade best is on the OTC and NDF desks of global banks. The how they trade is via derivatives and direct transfers for sanctioned commerce. And why this matters to you is because this is the marketplace that will ultimately determine the value and mechanism for any future conversion. Ignore the noise from the speculative fringe. Focus on the data from the trading floor. That's where the real story is unfolding.